Good morning and welcome to the latest edition of What's Up Monday. This is Dominic Chirichella and I'll be with you for today's program. As usual, if you have any questions, please feel free to email me at dchirichella@emi.org. I'd be very happy to answer any and all of your questions. So uh, it's looking already like this is going to be another crazy week. There's a lot of catalysts that are pushing oil prices mostly higher. We've been pushing the envelope, and we're going to talk a little bit about that, and hopefully add a little bit of insight to steer you in the right direction for your trading week. So with that, let's get started and see what we have in store coming this. And if we look at the 3-2-1 crack spread, which is widely followed, representing um, the equivalent of 67% gasoline yield, 33% distillate yield against WTI. You can see we're around average. So not a bad year for the refiners, and that's kind of going to keep refinery runs running higher. And we'll have to see where we go from here. But we're right in the middle of this 5-year min-max envelope, and we've been rising since the beginning of the year. Seasonally, we tend to throttle back here a little bit on refining margins as we get into the summer months, even though we're heading into this high demand gasoline driving season. Again, going back to that diesel gasoline spread, the June spread, it's been widening. I thought we had a window. I thought we were getting close to breaking down. Although I was looking to get long gasoline, sell the diesel. Right now, I'm strictly waiting on the sidelines until we see this how this pattern materializes here in the next week or so. If we look at the correlation of the externals, starting out with the dollar index, the 10-day average has kind of moved into a positive relationship, meaning that higher dollar and oil are not as correlated as they normally are. We generally are in a negative or inverse correlation. We were down there towards the end of the week. That 10-day moving average kind of moved out of correlation. The relationship between equities and oil is kind of still positive, but not nearly as strong as what the history tells us. We feel real strong when we're up here, and we feel real negative or positive for oil prices when that correlation is down there. Both of these are a little bit out of whack. They're offsetting each other. So we have a lot of mixed signals coming. It's just not clear cut. A couple of weeks ago, these two indicators were clearly the main drivers in the oil complex. They've kind of moved to the back burner a little bit with the other elements moving to the top of the list of drivers, as we've already talked about. As far as OPEC is concerned, another improvement. This will be the third week in a row that we see the relationship between the dollar basket price of OPEC crudes and the U.S. Dollar index, which again is that basket of currencies, 7 of them, with the euro being the highest, has kind of widened. And we've been in an uptrend for 3 weeks now. We're into the third week of the U.S. dollar stronger versus most of these major currencies, and that's dropped that gap, that purchasing parity gap between the dollar value of the OPEC basket and the dollar index adjusted value to 7.6%. So obviously this is very, very, very positive for OPEC. They're seeing oil prices rising, and they're seeing their purchasing parity improve. So again, I still look at the fact that it's negative, that this is bullish for oil because it'll keep OPEC from thinking about moving off of their high level of compliance, because they want not only higher oil prices, but they want higher U.S. dollar adjusted oil prices to improve their purchasing parity. So let's look at some of the fundamental charts around. As I said, I mean, that's a heck of a move to the upside. Each week we set a new record in the United States for U.S. crude oil production, and rig count continues to widen. This past Friday, the latest number, we increased by 9 new rigs being deployed to the oil sector. So that's rising. The rig count's going up. Oil prices are going up. Oil signs are positive. No indication that the upstream sector here in the United States is going to change their strategy. The single biggest problem, the single biggest issue right now facing the upstream sector, in particular in the Permian region of the United States, is the bottleneck on the distribution side. The logistics are just about at capacity. Even though the economics are favorable, that could potentially result in a slowing of the increase in crude oil production, especially from that region of the United States, which is the main growth region and has been the main growth region here for crude oil production. So I'd say stay buckled up. It's going to be a very crazy week. Again, watch those 30-second news snippets. That's where the signals are going to be coming from. However you look at that, whether it's on your trading systems, whether it's Twitter, whether it's whatever you're looking at, fundamentals are going to get interspersed in between. The economic data that's coming out this week is certainly always going to be every piece of economic data coming out is being viewed as, is it inflationary or is it not inflationary? And if it's viewed as inflationary, then we see bonds go up, and bonds go down, and we see interest rates, forward interest rates going up, and we see the potential for the Fed getting more aggressive. So watch where you're going, watch your back. The Iranian nuclear deal is in the forefront to start out this particular week. And again, if you have any questions, feel free to email me at dchurchill@emi.org. Good luck trading and hedging, and I hope you have a wonderful week.